So students, so far in my previous videos, we had discussed about one of the approaches to predict the share price movements, that is fundamental approach. So now in this video, I'll be discussing about technical approach. In the fundamental approach, share prices are analyzed on the basis of economic, industry and company statistics. If the price of a share is lower than the intrinsic value, an investor will buy it. If the price is higher than the intrinsic value, he will sell it and he will earn profit. Technical analysis involves the study of stock price movements in the security market. If there is an upward trend in price movements, an investor may buy the share. If there is a fall in price, he may sell it and he will move from the script. Both technical and fundamental analysis aim at ensuring a good return on investment. So in this, I will be discussing about the introduction to technical analysis and the aspects and the different charts of technical analysis and so on. What is technical analysis? It is a process of identifying trend reversals at an early stage to formulate the buying and selling strategies. Using several indicators, an investor analyzes the relationship between price volume and supply demand for the overall market as well as for the individual stocks. During an upswing, the number of shares traded is greater than before, and in a downswing, the number of shares traded will reduce and it will be lesser than the previous. If it is the other way around, trend reversals can be expected. What are the assumptions of technical analysis? Technical analysis has these assumptions. Interactions of supply and demand determine the market value of the script. The market discounts everything. The price of the security quoted represents the hopes, fears, and insider information of the market players. What is this insider information? It would be the information with respect to issue of bonus shares and right shares or rights issues which supports the prices. The loss of earnings and information regarding forthcoming labor problems also would act as an inside information, and this would result in fall in price. And these factors will cause a shift in demand and supply, changing the direction of trends. The market always moves in trend. Except for minor deviations, the stock price will move in trends. The price may create definite patterns also. The trend may be either increasing or decreasing, and it will continue for some time before it reverse. It is said that history repeats itself, and it is also true about the stock market. In a rising market, the investor psychology is positive and they purchase shares in greater volumes, driving the prices higher. In a downward trend, they may be they may be especially keen to get out of the market by selling the shares, thus plunging the share prices. Hence, technical analysis or technical analysts believe that past prices predict the future prices. So, friends, I will be discussing about Dow theory that was developed by Dow Jones, which is the most common technical tool which is used and this theory was developed to explain the movement of the indices of Dow Jones average. Charles H. Dow developed this theory to explain the movement of the indices of Dow Jones averages. It says that no single individual or buyer can influence the market's primary trend. The intermediate price movement also be affected to a lesser degree by an investor. According to this theory, it sees a trend as primary, intermediate, and short term. The primary trend may be a broad upward or downward movement that may last for a year or more than a year. The intermediate trends are corrective movements which may last from 3 weeks to 3 months. The primary trend may be interrupted by the intermediate trend. The short term trend, which refers to day to day price movements, may be for less than a day. It refers to the oscillations or fluctuations. These three types of trend can be compared to the tide, waves, and ripples in the sea. So, friends, you could see the trends or trend lines. So, the rising trend line in the sense the stock prices are rising, and also you could see that the trend line forward is higher than the trend line that was before. When you look at the upward trend, that is the rising trend, and also there will be a flat trend line, it means that either there will not be a rising trend or a falling trend. When you look at the falling trend, the forward falling trend will be still falling than the previous falling trend. So there are three types of trend lines: rising trend line, flat trend line, and the falling trend line. So now you would have a doubt, what is this trend? A trend is the direction of the movement. The share price may increase or fall or remain flat. So, the three directions of share price movements, they are referred to as rising, falling, and the flat trends that are explained in this figure. The points to be remembered is that share prices do not rise or fall in a straight line. Every rise or fall in price is accompanied by a counter moves. If a share price is increasing, the counter move will be a fall in the price and vice versa. Hence, the share prices will move in a zigzag manner. Trend lines are straight lines drawn connecting either the tops or bottoms of the share price movements. So, now what is trend reversal? The rise or fall in share prices cannot go on forever. The share price movement may reverse in direction. Before it changes the direction, certain patterns in price movement will emerge. Violation of the trend line shows the change in the direction of the trend. Violation of the trend line means the penetration of the trend line by the script's price. If a script price cuts the rising trend line from above, it is violation of the trend line and signals the possibility of a fall in price. This is called as trend reversal. So Dow explains that the trend in the market takes three forms: primary trend, intermediate trend, and short term trend. In primary trend, the security price trend may be either increasing or decreasing, and it will last long for a year, more than a year or two. When the market exhibits an increasing trend, it is referred to as bull market, and the bull market shows three clear-cut peaks. Each peak is higher than the previous one. The bottoms are also higher than the previous bottoms. The reactions following the peak usually halt before the previous bottom. The phases leading to the three peaks are revival, improvement, and corporate profits and speculation, which is shown in the graph. The revival period encourages more investors to buy scripts as their expectations about the future are high. In the second phase, increased corporate profits results in a further rise in price. In the third phase, prices advance due to inflation and speculation. The reverse is true with the bear market. In the same figure, the first phase of fall starts with the sorry. In this graph, you could see the first phase of fall starts with the abandonment of hope. The chances of prices moving back to the previous high level appear to be low. This results in the sale of shares. In the second phase, companies report lower profits and dividends. This leads to selling pressure. The final phase is characterized by the distress sale of shares. During the bear phase in the Bombay Stock Exchange, more than two-thirds of the stocks were inactive. Most of the scripts were sold below their par value. Secondary trend. The secondary or intermediate trend moves against the main trend and it leads to corrections. In a bull market, the secondary trend can result in the fall of about 33 to 66% of the earlier rise. In a bear market, the secondary trend carries the price upwards and corrects the main trend. The corrections would be 33 to 66% of the earlier fall. The intermediate trend corrects the overbought and oversold positions. It provides breathing space to the market. Compared to the time taken for the primary trend, secondary trend is swift and quicker. Minor trends or short-term trends or tertiary moves are the random wriggles that occur in price movements. They are simply the daily fluctuations. Minor trends try to correct the secondary trend movements. It is better for investors to concentrate on primary and secondary trend rather than on the minor trends. So, friends, it is important to understand the support and resistance levels while studying the trend lines. Support and resistance levels are the integral part of technical analysis. A support level exists at a price where considerable demand for that stock is expected to present a further fall in the price level. The fall in the price may be halted for time being or it may even result in a price reversal. In the support level, demand for the script is expected to remain. In the resistant level, the supply of script is greater than the demand and a further rise in prices prevented. The selling pressure is greater and the increase in price is halted for the time being. In the resistance level, the supply of scrip is greater than the demand and a further rise in price is prevented. The selling pressure is greater and the increase in price is halted for the time being. Support and resistance usually occur whenever the turnover of a large number of shares tends to be concentrated at a several price levels. When the stock touches a certain level and then drops, it is called resistance. And if the stock goes down to a certain level and then rises, then exists a support level. The levels constantly switch from one to the other, that is, from support to resistance or from resistance to support. Okay, so this in this figure you could see the support levels and the resistance levels. If the script price reverses the support level and moves downwards, it means that the selling pressure has overcome the potential buying pressure, signaling the possibility of a further fall in the value of the script. It indicates the violation of the support level and a bearish market. If a script penetrates the previous top and moves above, it is a violation of the resistance level. At this point, the buying pressure would be more than the selling pressure. If the script moves above the double top or triple top formation, it indicates a bullish market. The support and resistance levels need not be formed only on tops or bottoms. They can be on the trend lines or gaps of the chart. So now we will understand how to do technical analysis. Again, there are various techniques for understanding and performing technical analysis. So that is by understanding the theories like Dow theory, Elliott wave theory, you can make an technical analysis or you also can use charting and moving averages. So friends, in next video I'll be discussing about the charts and other patterns of technical analysis for better understanding.